Hello everyone. So basically, with Web3, essentially what is happening is there's a lot of changes, there's a lot of enhancements in the way the payments infrastructure works today. And what I'm trying to go out and talk about today would be majorly around the Web3 payments ecosystem, more from a perspective of global payments and how like blockchain is kind of enabling a lot of those infrastructural changes, the way in which money moves across the world. So let's just start with it. Like there are four things that I'm going to cover today. One, the Web2 payments, like how essentially the Web2 payments are working today. What are the challenges that we face with them? Then how are we seeing the use cases of payment coming on chain? And then talking about a few use cases, and then putting out some of the facts where essentially we see that there's a very good growth towards on-chain payment mechanisms coming to it. So let's start with that. Web2 payments, like if you look at global payments cross-border, essentially the way it works is like you have the whole Swift messaging infrastructure which has been created, and where essentially what you're doing is you're moving money from sender from A to B, and let's say you want to go out and send dollars, but the receiver has to receive euro. Essentially what is happening is it's going out and it is becoming like a very lengthy process where it is starting as like a messaging layer where your sender is going out and telling the sender bank through some Swift messages that how money is actually moving, how the sender has to send the money to the receiver. So from the sender's bank, they have to go out and find out the best route through which they can deposit the money to the receiver bank. And in that, you actually end up using a lot of those correspondent banking, which not only reduces your speed of payments, but it also increases the cost of moving money because there are multiple correspondent banks coming in between. So that is how the current global payment ecosystem has been working around. And like if you look at the cost, like I was talking about, this is like a report which has been published by World Bank, where essentially they're going out and saying per $200, like your cost of moving funds is on an average 11.69%. So that these are the two important figures. First, essentially, it has to be somewhere around around $200 that they're going out and talking about. And from the perspective of that, essentially, banks remain the most expensive ones. Like banks are actually going out and they're taking around 11.69% of the total money that you're actually trying to go out and move. And on an average, the average is 6.3%. So even from that perspective, if you look at the G20 countries, majorly South Africa, 15%, Brazil, 9%, Australia, 6%. So that is essentially one of the biggest challenges. And why essentially we are getting these high markups? Like, what is the reason for that? First, essentially, like why we are paying this much money? First, essentially, is like there's a huge amount of FX markups that these financial institutions do when you move money. Second, the cost of software. So essentially, like when you're going out and you're buying a particular, let's say, Swift terminal, they charge you around 10,000 to 15,000 per terminal. And then you have these back office costs where essentially there's a huge big team that essentially is working out and getting all these things done. So from that perspective, that is the cost of moving funds. And then like the speed of moving funds. I'll give you one example here. So essentially, let's say in LATAM, we have Netflix. So Netflix is headquartered in US, but they're going out and they're providing services worldwide. So so let's say they're providing the service of Netflix in Argentina. From Argentina, the money that needs to move from Argentina back to US in a Web2 way, it almost takes somewhere around 9 days. And this essentially now we are doing on-chain, and this whole thing happens in one single day, where you're going out and moving the payments on-chain through the use of stable coins on the blockchain itself, which are like public blockchains like Ethereum and Polygon. And essentially, all these money is getting settled at a very faster pace. So the speed of moving funds across border is like very slow. It takes almost 1 to 2 days for the sender to provide the sending money via ACH or card rails, 1 to 5 days if it is using correspondent banks, and 1 to 2 days to settle the last mile. And then this is one thing that essentially a lot of people never talk about, which is like cost of moving funds. Now, when you go out and move funds, essentially, when you are moving funds cross-border, there is something called a settlement risk. On an average, we are moving around to like somewhere around $7 trillion monthly. And from that perspective, there are three kind of major categories where these funds lie. First, which is like a pre-settlement netting. That means that whenever your funds are moving from bank A to bank B or correspondent bank A to B, they are insured, which means that the money will always come to you irrespective of whether or how it comes to you. So there's a guarantee which essentially is there. The second one is settled with risk migration, which is like a PVP. What PVP means is like it means payment versus payment. That technically means that when you're going out and making a payment, both the legs are starting or initiating in a way that they are settling at the same time. So both the parties who are moving money across each other, they're receiving the money on time. And the third one is without risk mitigation. So almost 19 currencies are covered in the first two, pre-settlement netting and settlement with risk migration. But almost 31% of the money, which is around $2.2 trillion, is moving with settlement risks. What does that mean? That means that, let's say, when 2008 fiasco was happening, and there was a money movement that was happening at that point of time. So let's say Bank A had to pay Bank B an X amount of money. Before that money actually went to Bank B, Bank A actually went bankrupt. Since there was no way to there was no pre-settlement netting or there was no settlement of risk migration, essentially like KWF Bank lost around 300 million euros in that. And this is something which is going on from a long period of time, and it's still going on. Like if you look at the last biggest settlement risk that happened was with Barclays Bank in 2020, which is like 3 years back. So from that perspective, essentially what is happening is a lot of money is moving across the world with no settlement, with no migration of the risk. And like if you look at Web3, it is still very nascent. So like if I talk about my entry into Web3 as well, it was majorly working with American Express in the Treasury Department, moving money. And the biggest challenge that I always had with that money movement was it was time consuming, it was at odd hours because global markets have their own timings. There was a lot of liquidity crashes, which I'll talk about a little bit later. But then when we started doing blockchain payments, or we talked about blockchains where these kind of money can be moved. So for reference, like Amex moves around $5 billion a day. So that kind of a volume, can that be moved today using blockchains? The answer is still no. Why? Because essentially what is happening is, though it is kind of like the whole ecosystem is growing very fast, but still there is not enough liquidity. There's still a lot of challenges, but we are going there, or we are reaching there slowly and steadily. So from that perspective, and also like when you go and pitch treasury managers, like we will move funds on chain and everything like that, it becomes like a nightmare for them to understand because they don't know what these things are. So the UX is still not simple enough for these treasury managers to actually be able to go out and move that money. So now, when we talk about, so this was like kind of an overview of what is happening with the Web2 world. How slowly and steadily, I would not say that it has already been completely transformed, but slowly and steadily how on-chain payments are catching up, and what they're doing actually is something that I would want to talk about now. So essentially, like if you remember earlier, there were like counterparty banks, there were correspondent banks, there was sender bank, there was a receiver bank. I don't know how many banks were there. Now, when you're going out and moving funds on chain, the biggest benefit that you have is you do not need anyone. Like from a perspective of all you need is a sender and the receiver. And if the currencies are available on chain, there's a good way in which you can go out and do everything on chain without including anyone in the intermediary process. So what are the things that we require? I'll talk about it just after this. But essentially what here you're going out and doing is essentially you have the fiat system where essentially what you're doing is you're doing an on-ramp in the form of money that you already have. So let's say you have USD, so you're on-ramping it into USDC, and then like someone else wants to receive it in euro. So what is happening is on-chain, there's a swap happening using a decentralized exchange and inbuilt smart contracts on the blockchain side itself. And then you're going out and getting that swap done, and you're receiving the euro. This whole movement of fund can happen within seconds. This all can happen in a fraction of the cost that essentially you were already paying. We'll talk about the cost also a little bit later. But this is how the movement of fund is happening. So if you remember the earlier slide, there were like 7 steps in which you were moving funds. Now here, those 7 steps have been reduced to 3 steps in actually going out and reducing the entire way. Okay. So now, talking about some of the very important aspects of what is required on-chain so that these flows can actually mature. The first thing is essentially like providing competitive rates on-chain, because you cannot go out and like none of the treasury guys would go out and use you if the rates that you're providing on-chain are not as competitive as the off-chain or the banking rates. So from that perspective, this is something which like we did a study around on-chain rates. And we found out that the traditional rails versus the on-chain rails, the arbitrage is less than 5 basis points. Now, this is kind of an acceptable one, because in general, like the best of the best rates include a 2 to 3 basis point slippage, which means that a 5 is much easier or is much accommodative towards an on-chain price movement. So that is the first thing which essentially is there, where you need to have like competitive rates to off-chain fund movements. The second thing is availability of liquidity. Now for cross-border payments, what happens is the moment US markets shut down on a Friday, and till Monday, till the Hong Kong markets have not started, there is a very big liquidity dearth in the overall global market, which is also represented by something called flash crashes. What that means is, like, if someone on a weekend wants to move a huge amount of money cross-border, there is not enough liquidity, and he will end up getting a very bad rate. So that is like the flash crashes that essentially happen. Now, if you look at kind of like on-chain, what is happening is the liquidity is relatively as good as the liquidity was on the weekdays, which technically means that irrespective of whether you are on a weekend doing something or you're on a weekday doing something, it does not matter, because technically you still have the liquidity available of ours, which means that if I want to go out and make a swap or move money cross-border on a Saturday, it might still have the same liquidity rates that were available for you on a Friday. So that is what essentially your on-chain payment kind of provides you. So this is again like we went out and had kind of like the total liquidity available on the Uniswap protocol from the perspective of Euro and USDC to look at how essentially they're kind of having the same amount of liquidity. So the purple one on a Saturday and a Saturday or Sunday, where essentially the flash crashes happen, you can actually go out and use on-chain money to actually go out and move the money without having those flash crashes which are there in the Web2 world. Now, when you talk about the costs that essentially we are going out and handling when the overall on-chain payments are happening, so there are like 4 fees which you technically go and end up paying. The first one is an on-ramp fees, and the last one is the off-ramp fees, which means that when you take your money and convert it into a stable coin, that is the cost that you're technically paying someone. So a lot of centralized exchanges enable this for free for you, which means that you don't have to technically pay anything, like when you're on-ramping to your centralized exchanges and you're off-ramping through your centralized exchanges. There are on-ramp, off-ramp providers which kind of can take an amount of fee. The second is like exchange fee. So like one of the pools that I'm running currently, that's like having 20 million liquidity on Uniswap. And the fees that I generate, every $100 million I generate because I'm providing the liquidity, is somewhere around $1,000, which means that per 100 million that has been moved, the cost of getting that swap done and getting that movement of fund done, you're only paying $1,000 per $100 million. So that is kind of like the exchange fee that essentially you're going out and paying. So it ranges between 1 bips to 5 bips. On an average in Web2 world, it ranges between 1 to 3 bips. So that is the amount of money that your market makers make when they're moving money across the world. The third is the network transaction fees. With so many networks coming in and giving you the fees in less than 1 cent or 1 cent, somewhere around that, that is the total cost. So if you add up all the cost and you're doing an on-ramp, off-ramp using a centralized exchange, you're technically paying nothing. You're paying like 1 basis point for moving the entire money across, and that is the only cost. So from that perspective, like I've created like 4 different avenues there. So if you're doing it through a bank per $100, the amount of fees, the total remittance fees that you might end up paying is more than 20%. If you're using money transmitter transfer operators, that comes to like 10 to 15%. And when you look at DeFi standalone on-ramps, which is like you're not using centralized exchanges and on-ramps and off-ramps, you end up paying like amount of fee per $100, somewhere around $10. So, and like if you look at DeFi exchanges where you're moving the money using Uniswap, decentralized exchanges, and using a centralized on-ramp, off-ramp, you're just paying less than like somewhere around $2 to $3 per $500. So that is how like essentially the overall cost is happening. And like this is kind of a comparison between how on-chain and off-chain funds come together today. So from a normal perspective of market hours, nominal 24-hour market off-chain like is not there. So you have intraday flash crashes on weekends, while on on-chain markets, it is a 24/7 market. In the settlement times, essentially, it takes T+2 days. However, if weekends and holidays, it can go up to T+5. And on-chain markets are instant. If you look at transparency and trade reporting, you have to have like manual trade reporting and everything done. On-chain, everything is reported on-chain, so you can just pull up the data and you can look at it. And from that perspective. And from a perspective of liquidity fragmentation also, what happens is the liquidity is fragmented. So another fact which essentially is there is around $7 trillion of money is stuck in bank accounts just because they need to provide liquidity. So for example, like let's say MoneyGram has around $300 million stuck in multiple banks across the world just to ensure that they're able to settle the last mile instantly. So that is the kind of liquidity fragmentation that is right now happening. Then if you look at liquidity providers, essentially the principal trading firms which are already there in the Web2 world, they kind of go out and do it. So that means only the large holders of currency can actually go out and do that. However, when you talk about on-chain markets, anyone who has access to stable coins can actually become a part of this and can start providing liquidity, which means that the capital can come in not just from the bigger institutions, but from the people who essentially kind of hold these stable coins. And like from a perspective of automation, on-chain, almost all those things can be automated. You do not need to kind of go out and have anything going out from a perspective of manual entries and everything like that. Everything of that can be automated from that perspective, where almost 27% of the cost associated with your cross-border payments is coming in from the back office costs. Now, from that perspective, like just looking at some of the use cases where kind of like stablecoins has become like one of the biggest use cases. If you look at the total volume, so this is something which I took in like 3 days back. Almost like if you look at 30 days volume, we have on-chain stablecoins have moved around $2 trillion. So that's not a small amount anymore where it can be ignored. And the total number of transactions, around 500 million transactions have happened in the last 30 days with a supply of around $154 billion on-chain. And almost 25 million people actually going out and accessing that. So from that perspective, slowly and steadily, all these chains and everything like that is coming to the picture to go out and increase the stablecoin use cases. The other thing which essentially is also getting created is all these wallets. And and with account abstraction, one of the biggest things that is happening is you do not need to know what chain it is. You do not need to know what is the gas fees, nothing like that. All you need to do is you kind of just need to go out, have the stable coins in your wallet, and at the back end, if it is natively account abstracted, you can just move the money as you go. Even from a perspective of use cases, slowly and steadily, what is happening is like a lot of cards have started to come in. Base card has been like very prominent, I think, in Singapore, if any one of you is using it. But like a lot of these cards where essentially what you can do is you can directly pay through your crypto. A lot of merchant accounts settlements where essentially you can go out and accept merchant payments to go out and get all your businesses to move money. So all those things are also slowly and steadily coming up. And then like if you look at like the crossover. So I always look at this as a crossover where essentially like if you look at stablecoin volumes today, like they're slowly and steadily going out and they're taking a good amount of shape. So if you look at stablecoins, they started somewhere around 2016. And like if you look at today, like stablecoins are facilitating a huge amount of trading volume. They're going beyond like the total amount of remittances that are moving. PayPal, they've kind of gone. I know there are like some movement of money which essentially is done, which is not kind of money movement. But what I want to kind of go out and say is like in less than 6 years, stablecoins have been able to reach nearly at parity with Visa. Visa kind of like settles somewhere around, I think, 15 to 16 trillion dollars every year. So from that perspective, the amount of money that essentially is getting settled using stablecoins is actually very much on the rise, and like it's going really very well from that perspective. And even from a perspective of like, I think the average user. So now if you look at like, is there a change in the behavior of the user? Is there like, are the users getting more comfortable using stable coins? The answer is yes. So this is something which we did like a study on the USDC wallet addresses transacting on Polygon. And like over 24 months, like this was the total transaction done, the total volume and everything like that. But the good thing to learn about here is the second one, that the transactions, the direct transactions account for almost 40% of the total transaction volume. And the average transfer has increased from $1,781 to $6,784, which means that generally everyone who essentially is moving money, they are getting more and more comfortable using stable coins to make movement of money. And like last but not the least, essentially, because of the payment ecosystem coming on chain, a lot of money market funds are slowly and steadily getting a lot of rise from that. If you look at BlackRock's Buddle, I mean, there are almost like 83 money market fund which have already gone on chain and tokenized themselves. Slowly and steadily, their value is also growing. So almost on chain, you have somewhere around $1.7 billion, which is a very small amount from a perspective of money market funds. But from a blockchain perspective, slowly and steadily, that is happening. And the way it would function out is the way it would move in the next phase is in treasuries, where essentially today, when you have excess cash, you have to go back to the banks and say, hey, can we take a 14-day money market, can we take a 14-day like a money market fund exposure, overnight fund exposure, or something like that, where essentially you're locking up the liquidity for a minimum number of days. If you're withdrawing it, you're paying a charge, you're paying a fee, and everything like that. However, on-chain, all these things become super easy because technically what you're doing is you can, instead of going out and having enough cash, you can have money market funds on chain, use them as collateral when you need instant cash, instead of selling off your entire overnight fund or something like that, and just get your cash requirements done. Once those cash requirements are completed, you again have the cash back. You can just deposit it back and get back your collateral, which was your money market fund. So a lot of those efficiencies are starting to get created. And once they do, essentially what will happen is like we'll see a lot more payments and settlements happening on chain from that perspective, rather than like being off chain. So I think that was like the presentation that I wanted to talk about. My name is Aishwarya. I head payments at Polygon. This is like, if you want to connect with me, this is my like how you can connect with me. Happy to answer any questions if you have from that perspective. Cool. I think that's pretty much it. Thank you so much for listening in.